Welcome back to Building Your Life podcast. My name is Doug Sandler, along with John Browning. John, you've done 160, I think this is 166, this episode. You've been in this game a long time.
Yeah, I enjoy it. I get a lot of good feedback from it. So that's, it's nice to have from my current clients and people who are not even clients, at least not yet. So if I enjoy it and I've got somebody like you to talk to, why not? Keep going.
Yeah, always great conversation. I always like talking about future money, financial advice, without giving me the advice, of course. See the disclaimer in the beginning of the meeting, all of that. One question I have that we haven't actually talked about is that plant behind you is never quite grown. I don't know if you can see it. For those of you listening on audio, you can't see it. Video, you've seen that plant. It's been just there every time.
Every single time. Yeah, I can't get it to grow. I don't know what the problem is.
So on today's episode, what I want to talk about is a problem that a lot of people have, speaking of problems, but they can't seem to quite shake it. And it's the tactics and strategies that you have to use or employ to stay comfortable when it may be tempting to try to time the market. Now, I had been previous life a big proponent on the buy high, sell low philosophy. And that is never a philosophy that gets you closer to retirement with any kind of stress-free living. So can we talk about that for just a quick second? Why do people get so wrapped up in the emotion and the trying to time the market? What's your experience show?
Two things. One is CNBC.
Okay. Yep.
It really is. I mean, it's not. I shouldn't just pick on CNBC. It's all the news shows that we tend to, we listen to or we watch. And hey, I have my daily 5-minute audio update that people can listen to as well.
Yeah.
And I try and really keep that. Number one, I'll tell you during that, whenever I record it, is that, hey, these things happen every single day, unless it's a major event that was completely unanticipated, then no action needs to be taken. We take note of all of the things that happen over long periods of time, and we use our telescope, so to speak, to look out over long periods of time. We don't take action based on what we hear on the newscast every morning, every evening, or whatever. That's number one, why people get all wrapped up in timing the market. And what they end up doing is exactly what you just said. They end up buying high because everybody's talking about, like right now, everybody and their brother's talking about AI, right?
Yep.
Artificial intelligence and all that. And money is just flying in there. And I'm not saying it's the wrong time to buy AI, but I am saying be very, very careful, because these companies' stock prices get higher and higher and higher, and it may begin to not make any sense at those high levels. Same thing happened with we'll pick on Bitcoin here for a second.
Mm-hmm.
And another gauge that I use is when Goldman Sachs says something's great for retail, turn and run the other direction, because right about the time Bitcoin hit about $60,000, Goldman Sachs says, we've got a way for the retail investor to invest easily in Bitcoin. And sure enough, within just a few months, it had started its downward decline. We know where that went. And now it's interestingly headed back higher for many different reasons. We don't want to get off on that rabbit trail.
Yep.
But those are some of the reasons that you see people trying to time the market, and there's so many proponents out there that just absolutely, and they believe it. They say we can do it, we can time it. I've been doing this for 30 years. I've seen people come on, the shows and say, hey, this guy timed the market because he bought Amazon at $2, and now look where it is. Or they timed the market, and they did, right? It's true. They timed like the housing crisis or whatever it was, certain event. Did they time it right getting back in? And could they have ever repeated that at any time since then? And the answer is literally 100% of the time, no. I have never seen anybody be able to do it consistently.
Well, historically, the market has its ups and downs. I'm just looking up, as you were talking, I was looking up the 10 worst years in the stock market history, 1931, of course, 2008, 1937, 74, 1930, and then 2002, 2022. So of the last basically 20 years, there's been at least three pretty serious downturns in the market. And, a lot of people, right as the market's turning down, they panic and they pull everything out, or they try to time the market and they pull it out what they think is right before. And then they try to get in, and they get in at the wrong time. What are the steps that people would need to take in order to avoid that emotional knee-jerk response of in and out so quickly? How do you compel people to relax and stay tight, other than sending out a mass email to your clients saying, don't panic, stay in the market, or it's not time to make a move, or like, how do you do it, and how do you teach them to do it?
Yeah, well, it's of course it's different for each individual. We all feel differently, and we all experience that pain or that joy in different ways. But the first thing to keep in mind is you will feel pain much, and this is a psychological testing that they've done for years. You feel the loss of pain much heavier than the joy of joy, so to speak.
Mm-hmm.
So that euphoria that you get when you invest in Bitcoin and it goes up $10,000 in the next month or whatever is great, but it is not nearly as bad as the pain of losing $10,000 in a couple months.
Yep.
In our brains, in our hearts, right? And so keeping that in mind, no matter how fast and hard the market is running up, it's educating and talking to our clients in that moment and saying, hey, take a little bit, not the whole thing, but trim, take things off the table. And if you're talking to them when the market's going up and you're convincing them, hey, this is also not the right time to just let everything ride, you have to take some off the table. Then when the market does begin to go down, you kind of remind them, remember we had this conversation, and the reason that you're not down more is because we took some of that off the table and we put it over here into something else, which is not down as much. Tough during 2022 when both bonds and stocks were down 20%, right? That was a tough year. But interestingly, here at Guardian Rock and a few other financial advisors who were aware of some of the things that you could have done outside of those two things, our clients tended to do okay. It still was painful, but at least they weren't in bonds trying to hedge the stock prices. And that's just part of the experience of being in the market as long as I've been. And there's a particular way to guard against what has traditionally been the right strategy, right? But it no longer is. It worked 10, 20, 30 years ago. It doesn't work given the market environment that we're in now. So that long experience is great, but if you stay stuck back here and the market moves forward, that's a problem. And that's what a lot of people did, including financial advisors. They didn't adapt to the changing market. So there's ways there are opportunities out there to protect yourself.
One of the things that I heard, speaking of protection in this environment, or any environment that's kind of a volatile environment, is that word diversification. And what's diversification mean to you as someone that's helping people out there in the world make some of these world life, decisions about their money?
That is a fantastic question. I'm glad you asked that, because diversification and asset allocation, two different things. And a lot of people use those two things synonymously, and they're not synonyms. So diversification is just the sheer number of different things that you're invested in. Mm-hmm. And there, just as a general rule of thumb, when we get a particular single security that gets to 5%, we'll let it ride. Like it's going good. We'll never invest in a single security 5% from day one, because law of diversification for me is you need to be under that, right? But if it appreciates, well, you don't want to just continue to sell your winners. You want to hold on to your winners, right? Mm-hmm. But only to a certain point. 5%, we're starting to think about trimming it just below 5%. At 7%, we have a hard and fast rule, unless we're specifically told not to by the client. We will trim that from 7% down to 5%.
And are you talking about 5% or 7% as in percentage of your portfolio invested in that specific thing?
In that specific security. That's right.
Got it. Very interesting. Okay. Yeah. I don't know this philosophy. I'm listening more now.
Yeah. So, but to give you the idea of what asset allocation is. So asset allocation is, there are different asset classes out there. And within there's subsectors of that. So there's what's called the GICS sectors. I'll just explain it real quick. There's 11 GICS sectors within the S&P 500. There's a technology, there's real estate, there's industrials, and those type of things. So within that those are sub asset classes of the stock market. There's also precious metals and commodities. And then there's also on the other side, there's your fixed income. And then in between there are ways and products that can protect you against all of those things, right? That can add some protection and maybe even produce some income. Just as an example, with the story about bonds and bonds falling, treasury bonds, right? The quote unquote safest things that you could purchase. Long treasury bonds fell 20% during 2022, just as bad as the S&P 500. And that took a lot of people off guard, because back 10, 20 years ago, the philosophy was you buy maybe 60% of your portfolio asset allocated to equities, and the rest maybe 40% allocated, or 30% allocated to bonds, and maybe 10% into commodities or something like that. Well, when interest rates got to like 1%, the bond math didn't work anymore. Right? So those of us who've been in the bond world for a long, long time and have the gray hairs to prove it, we started to realize, hey, the only place for these bonds to go is down in price, and possibly down a lot. So you started realizing that 60-40 old philosophy worked back then doesn't work now. So we use things like structured products to continue to add income, but just adds very specific downside protection on the equity side, or on maybe the commodity side.
So let's do this. I know we're running out of time for today's episode, so I want to wrap up here, but I want to bring back this subject in the future too, because I know a lot of the things that we're going to talk about involve diversification, asset allocation, choosing a financial planner, choosing a financial advisor, choosing an entire team of people that will help you. So if we could wrap it here, I'd love you to share how people can get in touch with you or Guardian Rock if they want to get more information about your services and the things that you offer too, John.
Sure. You can reach out to me by texting the word life to 321-421-5213. Or, of course, go out to guardianrockwealth.com, and there's a contact me button right there at the top and on every page. And there's also a lot of free resources there, a lot of free information, including this podcast and all the historical ones that we've done.
Excellent. And you've written a book also, and I want you to just take a quick second and just promote your book, because I think that people would, if they're not quite ready to have that conversation with you, but they want to see the wisdom in the pages that unfold in front of them, how can they do that?
So the book is called Build a Life, Not a Portfolio. You can find that on Amazon. Build a Life, Not a Portfolio by John Browning. It's an Amazon bestseller. So nice. Frankly, I don't need to sell more books. So if you would like, you can go to book.guardianrockwealth.com, and there'll be a way that you can fill out a form there, and I will send you an electronic version of the book, absolutely no cost to you. If you'd like a hard copy, I'm happy to send one of those as well. And it just costs me a little bit more money to send it that way. That's all.
Got it. All right. So pick up a copy of your book or get more information or get in touch with John directly on his website. All the links will be right there in the show notes. Thanks again for tuning in to another episode of Building Your Life podcast. We are excited to bring you this content. If you have information or more questions that you have about the things that John does, or you're curious about the answer to a question, just go ahead and contact John, give him the information that you want to know more about. And I know there's other people in our audience that want to learn about it too. So thanks for sharing. John, thanks for being here another week.
All right. We'll see you soon.